to do it the old-fashioned way. No remotes, just straight with the laptop. So now that I have you guys in complete suspense, the answer to this question, yes, yes, and yes. I see no reason that Social Security won't be around, and there are 3 reasons why that I'm going to cover here. So the first one, everybody on your Social Security statement sees in 2034, in 2035, Social Security could run out of money. Well, there's a caveat to that, and it's really not running out of money. 79% of Social Security will be covered by existing tax revenue at that time. A lot of times people are talking about the reserve that runs out. And even if the reserve runs out, 79% of your benefit is still there. So the decisions that you make need to be determined based on that. So if that doesn't make you feel any better, the other thing that I want to bring out is that there are solvency fixes that would last for 75 years that are proposed. Now, there's some good ideas, there's some bad ideas, but some of them are changing the retirement age. This has actually been done before. Back in 1983, retirement age was changed from actually 65 to 67 over a 20-plus year time frame. The thing that you have to think about is, well, what if they change my full retirement age right now? You know, if you're 62 or you're 65, are you worried about that? No one knows exactly what will happen, but in 1983, nobody over 45 years of age had their full retirement age changed. It was only people under 45 years. So if you're over 45, you're in a good spot. Under, you could see some changes happen to you with the retirement age. The second one is payroll tax. So payroll tax right now is paid half by the employee and half by the employer. And what we could do, now I'm not advocating for this, but what we could do is increase the payroll tax by about 3%. That would also solve it. Obviously, there's lots of economic consequences to doing that, but that is one of the fixes to Social Security. And then the last one here is taxation of benefits. For any high income retirees, you really could see this play an impact on you. So it's critical that you do planning for potential taxes of your Social Security benefits. At the moment, the highest amount of your Social Security that can be taxed is 85%. But this is something that they could change. Again, they actually started this back in 1983 as well, but we could see some changes here. So we've got the existing tax revenue, we've got the solvency fixes. Number 3 here, just the politics of it. I think I'm going to put a quote up here and read it. Should any political party attempt to abolish Social Security, unemployment insurance, and eliminate labor laws and farm programs, you would not hear of that party again in our political history. This is a quote by Republican Dwight D. Eisenhower, President, General, World War II. This is the politics of right now. It's really, really difficult to see Social Security being abolished or being changed drastically because it's a popular program right now. So we've got those 3 big reasons. And if you are still skeptical, I have some other advice for you. And that is, I actually have my personal Social Security plan, and that is her right there. She is a year old, and I'm giving her about another 2 years to go out there and find a job so she can pay for your Social Security and my Social Security. Tell your friends and your kids to do the same thing, problem solved. So lots more we could discuss with the solvency of Social Security, but we're going to operate today as if everything is going to be in existence in that 2034 timeframe, 2035, and throughout your entire retirement. All right. So the agenda for today, now that we've gotten that out of the way, we're going to talk about how does Social Security get calculated, number 1. Number 2, when should you begin collecting Social Security? And number 3, what are some important considerations for high income retirees? So starting off with number 1, how does Social Security get calculated? It's really, really important because that's going to determine some of your decision. Do I continue to work past full retirement age? What if I start collecting and I'm still working? All of this plays a part in how your Social Security gets calculated. So let's meet George. George is age 62, and his full retirement benefit is $3,268 a month. His full retirement age is 67, but at the moment he's 62, trying to figure out what should he do. So how do we get to that 3,268? And the answer is that you take the top 35 years of your earnings, not the most recent, the top 35 years projected all the way to full retirement age. So because George is 62, the benefits that he is that's stated on that statement are assuming he works until 67. That's critical. It's indexed for inflation, and it's assuming that he's working to age 67. So once we have those top 35 years and we adjust them for inflation, how do we get to that number? So there's a formula that the Social Security Administration calculates with income replacement ratios. Those income replacement ratios start, again, with that top 35 years. So George, his top 35 years averaged out, get us to $138,000 roughly. We then take that and divide it by 12 to get the monthly amount. The official term for this is called the average indexed monthly earnings, AIM for short. So that 11,518 is really what we're working from. And there are buckets. There are 3 buckets that the Social Security Administration fills up to determine your benefit. The first bucket is the first $960, and it's replaced 90%. So George's first $960 turns into $864 of Social Security benefit. The second is up to $5,785, and that replacement ratio is 32%. That gets us to the 1,500 or so, in addition to the 864. And the last bucket is anything over 5,785 is replaced at 15%. So if we look at the first bucket, second bucket, third bucket, add them all together, that's how we get the 3,268. So again, it's important to think about what are your top 35 years, and then also projecting out that to your full retirement age. That 3,268 is taking all of those assumptions into play. So number 2, when to collect. This is the big question, right? So if we take George here and we look at his Social Security statement, we can see at 67, that full retirement age number, there's that 3,268 again. If he delays, he gets 4,078 at age 70. But if he collects early, he would only get $2,261. So if we look at the percentages here, we say age 62, he would get about 70% of his full retirement age benefit. At 67, he's getting 100%. And at age 70, it's growing to 124%. So if we look at 70 versus 62, that difference for George is $1,817 more, almost double. So that's the benefit of delaying. But what's the cost? There's a cost to delay. A lot of people say, oh, it's an 8% return. Well, there's an 8% increase in the delay between 67 and 70, but there's a cost to that. So it's not a straight 8% return. The cost to that is that foregone 8 years of benefits. So if we say his age 62 benefit is 2,261, and we say annualized, that comes out to 27,000. Well, what's that look like over 8 years? $217,000 that he's giving up. But there's more. So 217,000 is if we don't take into account inflation, and if we don't take into account the time value of money, the opportunity cost, if you will. So if we think about that, if he's not collecting $27,000 a year, He could have taken that and invested that, maybe earn 4%, 5%, 6%, some type of return in the markets. But more realistically, what would happen is that it's not he'd invest that 27,000, it's that he'd be able to leave 27,000 in his portfolio that would continue to grow. So we have to take that opportunity cost into account. The second one is the cost of living adjustment, inflation. It's not just 27,000 that you get right at 62 that lasts forever. It grows a little bit per year, depending on what inflation was that year. So those all are costs that have to be factored in to determining, should I collect at 62? Should I collect at 70? So let's look at this. This is going to be one of the coolest graphs that you've ever seen. And this is showing us what is that cost of waiting and what will it look like. So let's start this off. So at age 62, we see that green line start there, right? So he hasn't started collecting because he wants to wait until 70, right? So he's losing on that 62 benefit, 63, 64, 65, all the way to age 70. And at age 70, with that inflation number and the time value money, the opportunity cost, he is out $284,000. That's what he has foregone in those 8 years. So how long does it take to get back that $284,000? Well, let's go. So he starts collecting at 70. He's getting that $1,800 more per month, along with that cost of living adjustment. So we're going up, we're going up, we're going up. We're at 80, 81, 82, 83, 84. The assumptions that I've used for that cost of living adjustment, the inflation, and the opportunity cost, it takes us to 85. So 85 is how long he'd have to live, 15 years past 70 to get that $284,000 back. It's a long time. It's not nothing. So, but let's see what happens after 85. So because of that cost of living adjustment is starting at that higher benefit, we start to see this grow exponentially. So it took him 15 years to get that 285 back, right? Well, at 85, we go to 90, 91, 92, he has made another $286,000 back. So he's doubled his money if he lives to 92. Does everybody live to 92? Of course not. So this is something that has to be considered. But the longer you live, the higher benefit that Social Security really plays into account in an exponential way. So we keep going, all the way at 100, and you see how big a benefit it is if you do end up living that long. All right. So with George, it's really just a question of life expectancy. If George was single, that's all you'd be looking at, really. There's, of course, a few other factors, but the main one is that life expectancy. But we have to meet his wife, Martha. Martha is receiving a benefit as well. She's receiving exactly half. Now, there's spousal benefits that we're not going to get into at the moment. But for this scenario, we're going to assume Martha is receiving exactly half. All right. So you see at 62, 67, 70, the same thing applies for her, right? At 62, 64, at 70, she's out 142,000. It grows, it grows, it grows. She breaks even at 85. And again, 92 doubles, and so on and so forth. But here's the most important thing to remember. So if you're single, as I said, it's life expectancy, right? Just your own. If you're married, you have to know this: the higher benefit survives. In this case, it's George. The higher benefit survives. So what does that mean? So let's go back to Martha's here, right? As soon as one of the spouses passes away, Martha's benefit is gone, out the door. It is, there's no more benefit left, because if Martha passed away, George would still have his benefit. If George passed away, Martha would get George's benefit. So let's look at this from that angle. At age 85, it's the first to die. Both must live to 85. So what are the chances of both George and Martha, living to 85? And that is, that's a much more difficult thing to answer. And because one of you might not live to 85, you might decide, okay, maybe I won't wait until 70. Maybe I'll collect it for retirement age. The break-even analysis should be done for that as well. But this is a concept that is critical to remember when making your decision. Let's look at George, though. At George, his benefit is the surviving benefit, regardless of who passes away first. So if we look at this again, that break even of 85, it's not about when does George pass away, it's when does the second to die. Only one of them must live to 85. So if you think that's possible, and we also look at that exponential curve of, well, what if one of you lives to 86, 87, 88, all the way to 92? There's a huge benefit to delaying that that higher earner. So for that reason, the higher earner should generally wait until 70. A lot of other things to consider, but that is I'll say rule of thumb for the higher benefit to at least consider. A lot of people look at this and they say, I don't want to wait until 70 to retire. Okay. And we understand that. And there's no reason that you need to wait until 70 if you can draw from other sources. And our suggestion would be to draw from other sources if available, because of that huge benefit of that higher earner benefit continuing. So why? Why should we wait until 70 beyond that question of the break-even analysis? And if we look at a portfolio compared to Social Security delaying it is a perfect hedge. So let's go through this. So low growth, what does that mean, right? If we're earning 2% in the markets or 3% in the markets instead of 5 or 6 or 7, well, that's not good for a portfolio. High growth is great for a portfolio. For that delayed Social Security benefit, if we think about that opportunity cost again, that thing you're giving up by delaying, if it's a low growth, then you're not giving up that much. So that's really good for Social Security. If we think about high inflation, this is a conversation that's come up in many client meetings. What if we experience high inflation? Well, inflation for a portfolio can be bad. For Social Security, if we think of that cost of living adjustment, that can be really good because it means your benefit will grow. And that higher benefit starting at 70, growing at, let's say, 2%, versus that 62 age benefit growing at 2%, you're getting a much larger bang for your buck at that age 70 benefit. So that's good. And then the last one is long life expectancy. If you live too long, there's a chance you run out of money in your portfolio. If you live to 100 or 105, the life expectancy is going to continue to increase as we have more advanced medical tech changes and technology, just people taking care of themselves. Delayed Social Security, if you live to 105, you still have that Social Security. So the reason beyond that break even of waiting is it's a perfect hedge if something bad happens to the portfolio. All right. So on to number 3 here. Important planning for high income retirees. You've decided when you want to collect, how Social Security is calculated, but if you are earning a higher income in retirement, what are these landmines you need to look out for? And the first one is Medicare. All right. At age 65, if you've stopped working, you're generally going on to Medicare Part A, Part B, you have a drug plan, and then also a Medigap plan. Well, for that Part B, it costs $148.50 per month. If you earn more than $176,000 as a married couple or $88,000 as an individual, that jumps up to $207 a month for each of you. If you go to the next level, $297, $386, $475, you can get all the way up to $505 per month for each person if you have a high income during retirement. Well, guess where your Medicare premiums come from? Your Social Security benefit. If you have started to collect Social Security and you're on Medicare, that premium, comes straight from your Social Security benefit, resulting in a lower Social Security check each month. So that's one thing. The second thing is taxation. So in 1983, one of the changes they made is they started taxing Social Security on a federal level. Well, if you make under $25,000 for modified adjusted gross income, we won't go into that today, but if you make under $25,000, you get it taxed at 0%. But if you go over 34%, you can be taxed 85% of your benefit. Now, let me clarify one thing here. That is not a 50% tax or an 85% tax. It is saying that 85% of the benefit can be taxed. So we've got the single threshold, the married. If you're over 44,000, you're going to be paying tax on 85% of that benefit. Something else you need to be thinking about. So how do we handle this? What's the answer? The answer is coordinating with your portfolio when you are retired. Should you withdraw from post-tax Roth accounts? Should you withdraw from pre-tax traditional accounts? Or should you withdraw from non-retirement accounts? Each of those buckets has a different tax consequence. And if you can manage that effectively, you can work with that Medicare threshold. You can work with the Social Security benefits, Social Security taxation threshold. Obviously, that taxation is a little harder than the Medicare benefits because it's lower, but all things that we really, really want to be planning ahead for. So let's look back at all of this, all right? So what are the takeaways that we really, really want to remember? The first one, your Social Security benefits are calculated on your top 35 years of earnings all the way to full retirement age. It is really important that you look at that Social Security statement, because if there is something wrong, which we've seen it multiple times, a zero in a year 10, 20 years ago, that needs to be corrected to whatever you earned that year. So it's really important you go back and look at that. The second one, if you're single, it's generally just based on your own life expectancy, figuring out what's your family history look like, what's your health, and that's going to help decide when you should collect. If you're married, don't forget, higher benefit survives. And then for the other one here, the retirement and Social Security start date does not have to be the same. Too many times people say, I don't want to work till 70. I don't want to work till 67. If you have other assets, a portfolio of pensions, those are all things that you can work to make that Social Security benefit stretch. Perfect hedge against portfolio. Remember, low growth, high inflation, and long life expectancy. All things that are really hurtful to a portfolio, all things that really make delaying Social Security beneficial. And then the last thing, just those high income retirees should really plan ahead. You want to be thinking about Medicare, want to be thinking about taxation, and of course, lots of other things beyond Social Security as well. So we have sped through this pretty quickly. I am going to open up for questions here in a second, but next steps. So if you are a current client and you've not yet talked about Social Security with your primary advisor, we really would suggest reaching out. We will do that generally proactively if you are reaching that age 62 timeframe. And if you're not a client and you need help planning ahead, consider reaching out to us and seeing if there's anything we can do to help, whether that's with Social Security or the broader financial planning and retirement planning in general. All right, so let's open it up to questions. Shannon.
Thanks, Graham. It looks like we have time for a couple questions. The first one that came through is, in a few years, I plan to take Social Security, but I still want to work at least part-time. How will working affect my Social Security?
All right, so 62, you want to keep working, but what if I collect Social Security? What happens? And the answer is that if you make over, I think it's around $18,000, $18,240, I think is last year's number. you will get a reduction of your Social Security in those years for $1 for every $2 that you make. So if you're collecting at 62 and you're making, $100,000, you're going to see your Social Security benefit be reduced during that time. They're going to take that away from you. And it's often referred to as a penalty. But keep in mind that that money is not gone forever. They're not taking it away from you and never giving it back. What's happening is at full retirement age, or when you stop working, that amount that they did reduce you by will be factored back into your future monthly benefits. So it's 1 for $2 when you're 62, 63, 64, all the way up until your age of full retirement age. And at full retirement age in that year, it's 1 for $3, and the income threshold's not 18,000, it's 44,000. And it's that 1 for $3. But once you do reach full retirement age, then there's no limit. You can make as much as you want, and they won't take anything away from you during that time frame.
Okay, great. Looks like another question we had is about a pension. It says, I'm eligible for a pension. How will the pension impact my Social Security?
Got it. So you're collecting a pension and you're wondering, will that impact your Social Security? Well, let's do this in 2 parts. So the first part is when I talked about if you're making money before full retirement age, you could be reduced. And that is just earnings and self-employment income. That is not pensions, it's not investment income. So if you make $30,000 in a pension, that 1 for 2 or 1 for 3 that I talked about, that doesn't apply to you. But with a pension, it depends on, was it covered or was it not? So teachers in California, they have a pension that is essentially replacing Social Security. So throughout their entire career of a teacher, they're not paying into Social Security. So they are subject to something called the windfall elimination provision. They're subject to, or their spouse to what's called the GPO. And that is, it's called the government pension offset. And that is something that you really have to look out for if your pension was replacing Social Security. And it is, you're not paying that Social Security tax while you were working. Now, on the other hand, teachers in Maryland, their pension is covered. They are paying Social Security. They are paying into the pension. So their Social Security benefit is not affected by whether or not they're starting their pension. Any other questions?
It looks like there might be one clarification question.
Yeah.
It says, in the calculations, how are the future years' income determined?
Yeah, great question. So let's go back to that. And actually, that might take a while, so maybe let's not. So how's that calculated? It's projecting out what you're making in that year and assuming there's going to be a small growth rate on that until you reach 67 or whatever your full retirement age. So if you're making $100,000 at 62, they might assume, well, you're going to make 102,000 at 63 and 104,000 at 64, 105,000 at 66. There's a small growth rate that, again, it's that inflation that they're looking into that takes you out all the way to 67. And those years that you haven't worked yet, but are before full retirement age, are part of that 35-year calculation.
Great. Thank you so much, Graham.
Well, if that is it, let's go back here to the last slide, because every month we do these webinars, and the next one is going to be on April 27th at noon. And we have our very own Chris O'Shea, our Chief Investment Officer, presenting that. And it is called A Portfolio Built for Time, Not Timing. So we hope to see you join us on April 27th. Thanks for joining us today, and we'll see you soon. Thanks.